Look, I need to be direct with you about something that's happening right now in the precious metals market. And when I say right now, I mean this is unfolding as we speak. There's a price adjustment coming, and if you've been sitting on the fence about gold and silver, you need to understand what's about to happen. Let me paint you a picture of what's going on behind the scenes. Central banks around the world are buying gold at a pace we haven't seen in decades. We're talking about 710 tons per quarter. That's not a typo. 710 tons every 3 months. These aren't retail investors panic buying coins. These are the world's most sophisticated financial institutions, the ones with access to information you and I will never see, and they're loading up like there's no tomorrow. Now, why does that matter to you? Because when central banks buy, they're not doing it for fun. They're not speculating. They're protecting their national reserves against something they see coming. And here's the thing that should make your ears perk up. They're doing this even with gold already at record highs. Think about that. Gold is more expensive than it's ever been, and they're still buying aggressively. What do they know that the average person doesn't? JP Morgan just came out with a forecast that should make everyone pay attention. They're predicting gold will average above $4,600 per ounce in the second quarter of next year, with prices potentially exceeding $5,000. Morgan Stanley is even more bullish, calling for $4,500 by mid-next year. Goldman Sachs Research is projecting $3,700, and that's their conservative estimate. These aren't fringe analysts or gold bugs making wild predictions. These are the biggest financial institutions on the planet, and they're all saying the same thing. Gold is going significantly higher. But here's where it gets really interesting. Silver is sitting in the shadows, and almost nobody is talking about what's brewing there. While everyone's focused on gold hitting new records, silver is coiled like a spring. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still historically wide. Throughout history, when gold runs, silver eventually catches up and runs harder. It's more volatile, more explosive, and right now, it's undervalued relative to gold. Let me tell you about something that happened back in 1979 and 1980. Gold went from around $200 to $850 in less than 2 years. That was impressive. But you know what silver did? It went from $5 to $50. That's a tenfold increase, while gold roughly quadrupled. Now, I'm not saying history will repeat exactly, but the pattern is worth understanding. When precious metals enter a bull market driven by monetary concerns, silver tends to outperform gold on a percentage basis. And right now, we're seeing all the same warning signs that preceded previous major runs. The real rate situation is fascinating. Real interest rates, which are nominal rates minus inflation, are at their highest levels in 18 years. Traditionally, high real rates are supposed to be bad for gold because gold doesn't pay interest. When you can get a decent return in bonds or savings accounts, the theory goes, why hold gold? But that's not what's happening. Gold and silver are surging despite these high real rates. That tells you something fundamental has changed in how investors and institutions view precious metals. They're not just inflation hedges anymore. They're insurance against systemic risk, currency debasement, and geopolitical instability. Speaking of geopolitical instability, let's talk about what's happening with the dollar's role in the global financial system. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to reduce their dependence on the US dollar. They're settling trade in their own currencies, building alternative payment systems, and yes, accumulating gold. This isn't a conspiracy theory. This is official policy from multiple governments representing billions of people and a massive chunk of global GDP. When countries move away from the dollar, they need something else to settle international trade and hold as reserves. Gold is the obvious choice because it's the only asset that's nobody's liability. It can't be printed, it can't be sanctioned, and it's been recognized as money for thousands of years. Every major currency devaluation or collapse in history has been followed by a flight to gold. And right now, we're watching the slow-motion devaluation of the world's reserve currency. Now, let me shift gears for just a moment because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, You need to understand that there's a way to get physical gold and silver into those accounts without triggering taxes or penalties. I put together a comprehensive guide that walks through exactly how gold IRAs work, the rules, the process, everything. It's completely free, and you'll find it in the description below. A lot of people don't realize this option exists, and it's worth understanding if you're thinking about protecting a portion of your retirement savings with precious metals. All right, back to what's happening in the market. The supply and demand fundamentals for both gold and silver are incredibly tight right now. On the gold side, mine production has been essentially flat for years. It's getting harder and more expensive to find and extract gold. The easy deposits have been mined. New discoveries are rare, and it takes 7 to 10 years from discovery to production for a new mine. So even if gold prices stay high and incentivize more exploration, we're not going to see a flood of new supply anytime soon. Silver's supply situation is even more interesting because silver is primarily a byproduct of other mining operations. About 70% of silver comes from mines that are primarily digging for copper, lead, or zinc. So silver supply doesn't respond to silver prices the way you might expect. Even if silver prices double, if copper prices are low, those mines might not increase production. And on the demand side, silver has this unique dual nature. It's both a monetary metal and an industrial metal. It's used in solar panels, electronics, electric vehicles, medical applications, and countless other industrial processes. As the world electrifies and goes green, industrial demand for silver is surging. Let me give you some specific numbers to chew on. Solar panel installations are projected to continue growing exponentially over the next decade. Each solar panel uses about 20 grams of silver. Electric vehicles use 2 to 3 times more silver than traditional cars. 5G infrastructure requires significantly more silver than 4G. We're talking about structural, long-term demand growth that has nothing to do with investment demand. And that industrial demand creates a floor under silver prices that gold doesn't have. But here's where the price hike warning comes in. Dealers and mints are already adjusting their premiums. The premium is the amount above the spot price that you pay when you buy physical metal. It covers the costs of refining, minting, distribution, and dealer markup. Over the past few months, as demand has increased, premiums have been creeping up. And there's a pattern that happens in precious metals markets. When spot prices start rising quickly, premiums often spike even higher because physical supply gets tight. Think about it from a dealer's perspective. If they sell you a coin today for $35 and tomorrow the spot price is $37, they need to replace that inventory at the higher price. So they start raising premiums to protect themselves. And if they think prices are going to keep rising, they might hold back inventory, waiting for higher prices. This creates a feedback loop where physical metal becomes harder to find and more expensive, even as the paper spot price is rising. We saw this exact pattern in 2020 during the COVID panic. Silver spot price went from $12 to $30, but premiums on physical silver coins went from $2.3 over spot to $8.10 over spot. So even though the spot price roughly doubled, the actual cost to buy physical silver more than tripled. People who waited, thinking they'd buy when prices came down, ended up paying more than if they'd bought at higher spot prices with lower premiums. And here's the thing about the first of the month. Many dealers adjust their pricing structures at the beginning of each month. They review their inventory costs, their supply situation, and market conditions, and they set new premium levels. If you're seeing warnings about buying before the first, it's because dealers are signaling that they're going to raise premiums based on what they're seeing in the wholesale market. Now, let's talk about what's driving this current surge beyond just central bank buying. The commercial traders on the COMEX, the futures exchange where gold and silver are traded, have been reducing their short positions. These are the big banks and trading firms that traditionally bet against gold and silver to hedge their physical positions or to profit from price declines. When they cover their shorts, meaning they buy back those contracts, it removes selling pressure from the market and often precedes significant price moves higher. The technical picture is also compelling. Gold has broken out of a multi-year consolidation pattern and is making new all-time highs. In technical analysis, when an asset breaks to new highs, it often continues higher because there's no overhead resistance, No previous sellers waiting to get out at break even. Every single person who ever bought gold is now in profit, which creates a psychological dynamic that supports further gains. Silver is approaching major resistance levels that, if broken, could trigger a massive short squeeze. There's been persistent speculation about concentrated short positions in silver held by a small number of large traders. If silver breaks through key technical levels and those shorts are forced to cover, we could see the kind of explosive move that silver is famous for. I'm talking about the potential for 20%, 30%, even 50% moves in a matter of weeks. Let me tell you about the paper versus physical dynamic that most people don't understand. The vast majority of gold and silver trading happens in paper markets, futures contracts, and ETFs where no physical metal changes hands. It's estimated that for every ounce of physical silver, there are hundreds of ounces of paper claims. This works fine in normal times, but if there's ever a rush to convert paper claims into physical metal, the system could break down spectacularly. We got a glimpse of this in early 2021 with the Reddit silver squeeze movement. Retail investors, coordinating online, tried to buy physical silver to expose the paper market manipulation. While the movement didn't achieve its stated goal, it did cause temporary shortages of retail silver products and highlighted how fragile the physical supply chain is. Imagine what happens if institutional investors or a sovereign nation decides they want physical delivery of their paper positions. The London Bullion Market Association, the LBMA, which oversees the professional gold and silver market, has been dealing with stress in the physical delivery system. There have been reports of delays, logistical challenges, and concerns about whether there's enough physical metal to back all the paper claims. This is the kind of structural issue that can lead to a sudden repricing where paper and physical markets diverge, and physical metal commands a significant premium. Here's another angle most people aren't considering: the wealth effect and generational wealth transfer. Baby boomers, the wealthiest generation in history, are aging and thinking about wealth preservation. They remember the 1970s when gold and silver were the only assets that protected purchasing power during stagflation. Many of them are looking at current economic conditions, massive government debt, persistent inflation despite rate hikes, and they're seeing echoes of that era. As they shift even a small percentage of their wealth into precious metals, that's an enormous amount of buying power entering the market. At the same time, younger investors who grew up with Bitcoin and cryptocurrency are starting to discover gold and silver. They understand the concept of hard money and limited supply. They're skeptical of government and central banks. And they're realizing that gold and silver have properties that even Bitcoin doesn't have. They're physical, they have thousands of years of history, and they can't be hacked or lost in a hard drive crash. This convergence of older investors seeking safety and younger investors seeking alternatives to the traditional financial system is creating a demographic wave of demand. Let's talk about the inflation situation because this is critical. Official inflation numbers have come down from their peaks, but anyone who shops for groceries, pays rent, or buys insurance knows that prices are still significantly higher than they were a few years ago. And more importantly, they're not coming back down. We've had price inflation, and now we're in a period of price stability at these elevated levels. Your dollar buys less than it did, and that loss of purchasing power is permanent. Gold and silver are responding to this reality. They're not just inflation hedges in the traditional sense. They're purchasing power preservation tools. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 50 years ago, 100 years ago, even 2,000 years ago. The same cannot be said for any fiat currency. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created, and the pace of that loss is accelerating. Think about what's happened to the money supply. During the pandemic response, governments and central banks created more money in 2 years than in the previous decade combined. That money is still in the system. It's in bank accounts, it's in financial assets, and eventually it flows into the real economy and causes prices to rise. The Federal Reserve can raise interest rates to slow down the velocity of money, but they can't make that money disappear. It exists, and it's devaluing every dollar you hold. Now here's where the timing element comes in. Markets don't move in straight lines. Gold and silver will have pullbacks, corrections, and consolidation periods. But the overall trend is clearly higher, driven by fundamentals that aren't going away. The question isn't whether gold and silver will be higher in the future. The question is whether you'll buy before or after the next leg up. And right now, we're at an inflection point. The technical indicators are aligned. The fundamental drivers are in place. Institutional money is flowing in. Central banks are buying. Supply is tight. And premiums are about to increase. This is the kind of setup that, when you look back in 6 months or a year, you'll either be glad you acted or you'll be kicking yourself for waiting. Let me address the common objections people have. Gold and silver don't pay dividends or interest. True, but they also don't have counterparty risk. They can't go bankrupt. They can't be inflated away. In a world where banks can fail, where bonds can default, where currencies can collapse, having a portion of your wealth in an asset that's nobody's liability is valuable. Think of it as insurance. You don't buy insurance hoping to use it. You buy it for peace of mind and protection against worst-case scenarios. The price is already high. I should wait for a pullback. This is the most common mistake investors make. They wait for a better price, and the price keeps going higher. Yes, gold and silver are at elevated levels. But if the forecasts from J.P. Morgan, Morgan Stanley, and Goldman Sachs are even close to accurate, today's prices will look cheap in hindsight. And remember, central banks are buying at these levels. They have access to better information and analysis than any retail investor. If they think it's a good buy at current prices, that should tell you something. I don't know how much to buy or what form to buy it in. This is a legitimate concern, and it's why education is important. Generally, financial advisors suggest that precious metals should be 5% to 20% of a diversified portfolio, depending on your risk tolerance and financial situation. As for what form, it depends on your goals. If you want the lowest premium and the most liquidity, you might choose bullion bars or rounds. If you want recognizability and potential numismatic value, you might choose government-minted coins. If you want the convenience of storage and the ability to trade quickly, you might choose an allocated storage program or a physically backed ETF, though those come with their own considerations. Here's something else to think about: the psychological aspect of owning physical precious metals. There's something tangible and reassuring about holding real money in your hand. In a world of digital accounts, electronic transfers, and abstract financial instruments, gold and silver are real. You can see them, touch them, and store them. They exist outside the banking system. If there's ever a financial crisis, a bank holiday, or a system failure, your physical precious metals are still there, still valuable, still yours. We're living through a period of unprecedented monetary experimentation. Negative interest rates, quantitative easing, central bank digital currencies, these are all uncharted territory. Nobody knows how this ends. But history provides some clues. Every time governments have debased their currency, every time central banks have printed money without restraint, every time the financial system has faced a crisis, gold and silver have preserved wealth. They've been the constant in a world of variables. The smart money is positioning now. They're not waiting for confirmation. They're not waiting for prices to come down. They're not waiting for the perfect entry point. They're buying because they understand that the risk of not owning precious metals is greater than the risk of buying at current prices. They're buying because they see the same warning signs that preceded every major precious metals bull market in history. And let's be clear about what a bull market in gold and silver looks like. It's not a steady, gradual climb. It's a series of explosive moves higher, separated by consolidations and pullbacks. The gains come in bursts, often when you least expect them. If you're not already positioned, you miss those moves, and those moves are where the real wealth is created. I want you to imagine two scenarios. In the first scenario, you buy gold and silver now, and prices pull back 10% or 15% over the next few months before resuming their upward trend. You're temporarily underwater, but you're positioned for the long-term move higher. In the second scenario, you wait for a pullback that never comes, and prices surge 30%, 40%, 50% higher. You're sitting on the sidelines, watching your purchasing power erode, kicking yourself for not acting when you had the chance. Which scenario would you rather be in? The dealers who are warning about price hikes after the first aren't doing it to create false urgency. They're doing it because they're seeing what's happening in the wholesale market. They're seeing their costs increase. They're seeing supply tighten. They're seeing demand surge, and they're adjusting their pricing accordingly. This is basic economics. When demand exceeds supply, prices rise. Here's the bottom line. The precious metals market is at a critical juncture. All the indicators, technical, fundamental, and sentiment, are pointing towards significantly higher prices. Central banks are buying aggressively. Major financial institutions are forecasting substantial gains. Supply is tight and getting tighter. Demand is strong and getting stronger. And premiums are about to increase. You have a decision to make. You can act now, while premiums are still relatively reasonable, while inventory is still available, while you can still get in before the next major leg up. Or you can wait, hope for a better opportunity, and risk paying significantly more later or missing the move entirely. This isn't about fear or panic. This is about recognizing a rare alignment of factors that creates opportunity. This is about understanding that the financial system is changing, that the rules are different now, and that the old playbook doesn't work anymore. This is about taking control of your financial future and protecting your wealth with assets that have stood the test of time. The warning is real. The price hike is coming. The question is whether you'll act before or after. The smart money has already made their decision. They're buying now at record prices because they know what's coming. They understand that in a world of unlimited money printing, limited supply assets become infinitely valuable. They understand that gold and silver aren't just investments, they're insurance against the unthinkable. So here's my challenge to you. Do your own research, look at the data, consider the fundamentals, and make an informed decision. But don't let analysis paralysis keep you on the sidelines. Don't let the perfect be the enemy of the good. Don't wait for the ideal entry point that may never come. The time to act is now, before the premiums increase, before the next surge in prices makes today's levels look like a bargain. The precious metals market is sending a clear signal. The only question is whether you're listening, because once this train leaves the station, once the next major move begins, the opportunity to get in at reasonable prices will be gone, and you'll be left wondering why you didn't act when you had the chance. Don't let that be you. Don't hesitate. The warning has been issued, the clock is ticking, and the first is coming fast.